Let me share something with you that I have never talked about publicly before. Something deeply personal, something that has fundamentally changed how I think about investing, about wealth, and about what really matters in the final chapters of life. I am 94 years old. I have been investing for over 80 years. I have built one of the largest fortunes in human history. And for the first time in my life, I am thinking seriously about endings. Not in a morbid way. I am in good health and I plan to keep running Berkshire for as long as I can. But at 94, you cannot ignore the reality that time is finite. The investment horizon that once stretched for decades now stretches for years. Maybe a decade if I am fortunate, maybe less. This reality has changed my portfolio strategy in ways that might surprise you. The changes are not dramatic. I am not suddenly buying gold or hiding cash under my mattress, but the emphasis has shifted. The priorities have evolved. The questions I ask before making an investment are different than the questions I asked at 50 or 60 or even 70. Today, I want to share this final portfolio strategy with you, not because I think everyone should copy exactly what I am doing. Your circumstances are different from mine, but because the principles that guide my thinking at 94 are relevant for anyone over 70 who is trying to navigate the complex challenge of managing money in the later stages of life. This is not just about maximizing returns anymore. It is about something deeper, something more important. And I wish someone had explained this to me decades ago, because I would have approached the whole journey differently. I think about Charlie Munger, my partner for over 60 years, who passed away recently at 99. Charlie and I spent countless hours discussing not just investments, but life, how to live well, how to think clearly, how to face the inevitable with equanimity. Those conversations shaped my thinking about money in the later stages of life more than any investment book ever could. Charlie used to say that the best thing a human being can do is to help another human being know more. That is what I am trying to do today, not because I have all the answers, but because I have learned some things over 94 years that might help you navigate your own journey. Let me also say this clearly. The strategies I am about to share are not about getting rich. If you are over 70, the time for getting rich has largely passed. You either accumulated wealth during your working years or you did not. What matters now is protecting what you have, using it wisely, and finding meaning beyond the numbers on a statement. Let me start with the most important insight I have gained in recent years. When you are young, investing is about accumulation. You are trying to build wealth. You have decades ahead of you to recover from mistakes. You can afford to take risks because time is on your side. The goal is to grow your pile as large as possible. When you are over 70, everything changes. You are no longer accumulating. You are distributing. You are drawing down the pile you spent a lifetime building, and the rules that govern accumulation do not apply to distribution. Here's what I mean. When you are accumulating, a 50% market crash is actually an opportunity. You can buy more shares at lower prices. Your regular contributions purchase more stock. When the market recovers, you are wealthier than if the crash had never happened. Time heals all wounds. When you are distributing, a 50% market crash is potentially catastrophic. You are selling shares to fund your living expenses. You are selling at depressed prices. You are depleting your principal at exactly the wrong moment. And you may not have enough time for the market to recover before you need the money. This asymmetry is the central challenge of retirement investing. The same volatility that helps young investors can destroy older ones. The same risk that builds wealth during accumulation can devastate it during distribution. Understanding this asymmetry is the foundation of my final portfolio strategy. Everything else flows from it. The first principle of my strategy is capital preservation. This might sound obvious, but let me explain what I mean and why it matters so much. 894, I do not need more money. I have more than I could spend in 100 lifetimes. But I care deeply about preserving the capital I have because that capital serves purposes beyond my personal consumption. It funds the philanthropy I am committed to. It provides for people I care about. It supports the businesses and employees of Berkshire Hathaway. For most people over 70, capital preservation matters for more personal reasons. Your savings must last for an uncertain number of years. You cannot go back to work if you run out. Social Security provides a floor, but for most people it is not enough to maintain their standard of living. The capital you have accumulated is the buffer between comfortable retirement and financial stress. This means avoiding catastrophic losses is more important than maximizing gains. I would rather earn 6% with minimal risk than chase 10% with significant downside. The extra 4% is not worth it if it comes with a 20% chance of losing half my money. Let me put some numbers around this. Suppose you have $1 million at age 70. If you earn 6% annually and withdraw $50,000 per year, your money lasts approximately 25 years. Well, past age 95, if you try to earn 10%, but experience a 50% crash in year 5, you might run out of money by age 85, even if returns normalize afterward. The math is unforgiving. Big losses in early retirement years create a hole that is nearly impossible to dig out of. This is called sequence of returns risk, and it is the biggest threat to retirement security. Let me tell you a story that illustrates this vividly. I knew two brothers who retired in 2000 and 2008 respectively. Both had accumulated $1 million. Both planned to withdraw $50,000 per year. The brother who retired in 2000 immediately faced the dot-com crash. His portfolio dropped to $600,000 in the first year. He kept withdrawing $50,000 because he needed it to live. By the time the market recovered, his portfolio had been permanently impaired. He ran out of money at age 82. The brother who retired in 2008 also faced an immediate crash, but he had structured his portfolio differently. He kept 3 years of expenses in treasury bills. He did not have to sell stocks during the crash. He drew from his safe money while waiting for stocks to recover. By 2013, his portfolio was back to where it started, and he still had decades of runway. Same starting point, same withdrawal needs, completely different outcomes because of how they structured their portfolios. This story haunts me because it shows how much the timing and structure matter. You cannot control when the market crashes, but you can control how vulnerable you are when it does. My response to this risk is to maintain a larger allocation to stable, income-producing assets than I would have recommended for myself at a younger age. I still own stocks. I still believe in equities for long-term wealth building, but the balance has shifted towards safety. The second principle is simplicity. As I have gotten older, I have come to appreciate the value of simplicity in a way I did not when I was younger. When you are 70 or 80 or 90, you do not want to spend your days monitoring a complex portfolio of dozens of holdings across multiple asset classes. You do not want to stress about rebalancing or tax loss harvesting or the latest market gyrations. You want to live your life, spend time with family, pursue interests that matter to you. A simple portfolio allows this. A complex portfolio demands constant attention and creates constant anxiety. My portfolio has become remarkably simple over time at Berkshire. Our largest holding is Apple, which represents a huge portion of our equity portfolio. We own Coca-Cola and American Express, positions I have held for decades. We own some Japanese trading companies and Occidental Petroleum. We have a massive pile of treasury bills that is essentially it for our major positions. I could complicate this. I could diversify into dozens of smaller positions. I could add alternative investments and hedge funds and private equity. But why? The simple portfolio lets me sleep at night. It lets me focus on what matters, and it has performed just fine. For individual investors over 70, I recommend a similar approach. Own a handful of quality investments you understand, maybe a broad index fund, maybe some dividend-paying blue chips, maybe some short-term bonds or treasury bills. You do not need complexity. You need clarity. One specific recommendation I have made repeatedly is that most people should simply own a low-cost S&P 500 index fund. This gives you ownership of 500 of America's best companies in a single investment. No research required, no decisions to make. Just buy it and hold it for retirees. I would pair this with a meaningful allocation to short-term treasury bills or a money market fund. This provides stability and liquidity. It gives you cash to draw from during market downturns, so you do not have to sell stocks at depressed prices. A simple portfolio might be 60% in an S&P 500 index fund and 40% in short-term treasuries. Adjust the percentages based on your risk tolerance and income needs, but keep it simple. Complexity is not your friend at this stage of life. I want to elaborate on why simplicity matters so much, because this goes against everything the financial industry wants you to believe. The financial industry makes money when you do things. When you buy, when you sell, when you hire advisors, when you purchase complex products. Every transaction generates fees. Every layer of complexity generates commissions. The industry has a powerful incentive to make investing seem complicated, because complicated means profitable for them, but complicated does not mean better for you. The evidence is overwhelming that simple, low-cost strategies outperform complex, expensive ones over time. The S&P 500 index fund beats the vast majority of actively managed funds over any meaningful time period. Not because index funds are brilliant, but because they avoid the fees and mistakes that plague active management. AT 70 or 80, you do not have time to recover from the mistakes that complexity invites. Every unnecessary decision is an opportunity to do the wrong thing. Every additional holding is something else to monitor and worry about. Every layer of complexity is a place for something to go wrong. I think about the estate plans I have seen over the years, the ones with dozens of trusts and LLCs and offshore structures. They were set up by sophisticated attorneys and accountants. They were supposed to minimize taxes and protect assets. But when the original owner passed away, no one understood how they worked. The heirs spent years and hundreds of thousands of dollars in legal fees trying to untangle the mess. The complexity that was supposed to help instead became a burden. The same thing happens with complex portfolios. The original owner might have understood why they held 30 different positions across 12 asset classes, but when they become incapacitated or pass away, their spouse or children are left with a bewildering array of holdings they do not understand. Decisions get delayed, mistakes get made, value gets destroyed. Keep it simple, not just for yourself, but for whoever will have to manage your affairs when you cannot. The third principle is income generation. When you are over 70, income becomes critically important. You need cash flow to fund your living expenses. You cannot wait decades for capital appreciation to materialize. You need money now, every month, every year. This is why I have always loved dividend-paying stocks. A company like Coca-Cola pays me dividends every quarter, regardless of what the stock price does. The income is reliable, predictable, and growing. I do not have to sell shares to generate cash. The cash comes to me automatically. AT Berkshire. We receive over $700 million per year in dividends from Coca-Cola alone. That is more than half of our original investment coming back to us every single year. And the dividend keeps growing as Coca-Cola raises its payout. For individual investors, dividend stocks and dividend-focused funds provide similar benefits. You build a portfolio of companies that pay you to own them. The income funds your retirement. And if you do not need all the income, you can reinvest it to grow your position. I would focus on companies with long track records of paying and raising dividends, companies that have paid dividends for 25 or 50 consecutive years, companies whose dividends have grown faster than inflation over time. These are the businesses that will provide reliable income through whatever economic conditions we face. Treasury bonds and treasury bills also provide income, although less than they did historically at current rates. Short-term treasuries yield around 4 to 5%. That is not spectacular, but it is meaningful on a $500,000 treasury allocation. you are receiving $20,000 to $25,000 per year in interest. That pays a lot of bills. The combination of stock dividends and bond interest can generate substantial income without requiring you to sell principal. This is the ideal situation for a retiree. You live off the income your portfolio generates while the principal remains intact or even continues to grow. Let me give you a concrete example of how this works. Suppose you have a portfolio of $500,000. You allocate $300,000 to dividend stocks yielding 3% on average and $200,000 to treasury bills yielding 4.5%. Your dividend stocks generate $9,000 per year. Your treasuries generate $9,000 per year. That is $18,000 in annual income without touching principal. No add Social Security. The average Social Security benefit is around $20,000 per year. Combined with your portfolio income, you have $38,000 annually before touching any principal. For many retirees, this is enough to cover basic expenses: housing, food, utilities, healthcare premiums. You are not depleting your portfolio at all. The principal remains intact, potentially growing if dividends are reinvested or stock prices appreciate, for expenses beyond the basics: travel, gifts, hobbies. You can draw from principal as needed, but you are only touching principal for discretionary spending, not necessities. This provides enormous peace of mind and financial security. The key is building your income sources while you still can. Every dollar of dividend income you establish before retirement is a dollar you do not have to withdraw from principal later. The time to build this income stream is in your 50s and 60s, before you actually need it. If you are already over 70 and have not built significant income streams, it is not too late. Gradually shift your portfolio toward income-producing assets. Reinvest the income until you need it. Even a few years of compounding income can make a meaningful difference. I also want to mention qualified dividends because the tax treatment is important. Most dividends from U.S. stocks qualify for preferential tax rates, either 0% or 15% for most retirees, compared to ordinary income rates that can reach 37%. This makes dividend income more valuable after taxes than bond interest or Social Security, which may be partially taxable. Structure your income sources with taxes in mind. Take income from the most tax-efficient sources first. Save the less efficient sources for last. These decisions can meaningfully increase your after-tax income over a multi-decade retirement. The fourth principle is what I call strategic inactivity. This might be the most important principle of all for investors over 70. When you are young, you can afford to make mistakes. You have time to recover. You can learn from your errors and try again. Activity has limited downside. When you are over 70, mistakes are much more costly. You do not have time to recover. A bad decision can permanently impair your financial security. Activity has significant downside. The best decision is often no decision at all. Hold what you have. Resist the urge to tinker. Ignore the headlines. Turn off the financial news. Stop checking your portfolio every day. I have watched countless retirees destroy their financial security through excessive activity. They see the market drop and panic sell at the bottom. They hear about a hot stock and buy at the top. They listen to some guru on television and restructure their entire portfolio. Every action creates an opportunity for error. The investors who do best in retirement are the ones who do the least. They set up a sensible portfolio and then leave it alone. They do not react to every market wiggle. They do not chase performance. They do not try to time the market. I call this strategic inactivity because it is not passive or lazy. It is a deliberate choice to avoid actions that are more likely to hurt than help. It requires discipline to do nothing when everyone around you is doing something. But that discipline pays enormous dividends. 894. I practice strategic inactivity religiously. I do not trade frequently. I do not react to short-term market movements. I do not let the news dictate my investment decisions. I sit on my hands and let time and compounding do the work. Let me tell you about a study that shaped my thinking on this. Fidelity analyzed which of their accounts performed best over a decade. The top performing accounts belonged to people who had forgotten they had accounts or who had died. People who literally could not trade outperformed people who actively managed their money. This is not a fluke or anomaly. It is a consistent finding across studies. The more you trade, the worse you do. The more you react, the more you lose. The best results come from patient inactivity. Why is this? Several reasons. Transaction costs eat into returns every time you buy or sell. Taxes are triggered when you realize gains. Most importantly, human psychology leads us to make exactly the wrong decisions at exactly the wrong times. When the market crashes, fear overwhelms us. We want to stop the pain we sell at the bottom. When the market soars, greed takes over. We want to participate in the gains. We buy at the top. Every emotion pushes us toward the wrong action. The only reliable solution is to remove yourself from the decision-making process. Set up a sensible portfolio. Automate contributions if you are still saving. Automate withdrawals if you are spending, and then do nothing. Check your statements quarterly to make sure there are no errors. Rebalance annually if your allocations have drifted significantly, but otherwise, leave it alone. I know this advice is hard to follow. Doing nothing feels irresponsible. Surely there is something you should be doing to optimize your portfolio. The financial media certainly makes it seem that way, with constant coverage of what you should buy and sell and watch. But the media has different incentives than you do. They need you to watch, to click, to engage. If they told you the truth, that the best strategy is to do nothing, you would tune out. So they manufacture urgency and drama to keep you hooked. Do not fall for it. The peace of mind that comes from strategic inactivity is itself valuable. Not stressing about the market, not checking prices constantly, not lying awake at night worrying about your portfolio. These benefits are worth something even beyond the financial returns. The fifth principle is legacy planning. This is something that becomes increasingly important as you age, and something that most investment advice completely ignores. When you are over 70, you need to think about what happens to your wealth after you are gone. Who will inherit it? How will they receive it? What structures need to be in place to ensure your wishes are carried out? This is not just about estate taxes and legal documents, although those matter, and it is about preparing the next generation to handle wealth responsibly. It is about communicating your values and intentions. It is about ensuring that the capital you spent a lifetime building continues to do good after you are gone. I have spent enormous time and effort on legacy planning. My will directs that virtually all of my Berkshire shares will go to philanthropic foundations over time. I have worked closely with my children to ensure they understand my intentions and are prepared to execute them. I have been explicit about my values and expectations. For most people, legacy planning is simpler, but still important. Make sure you have a will. Make sure your beneficiary designations are up to date on retirement accounts and insurance policies. Make sure someone you trust knows where all your accounts are and how to access them. I have seen too many families torn apart by unclear or non-existent estate plans, children fighting over assets, spouses left without access to accounts. Tax bills that could have been avoided with basic planning. These outcomes are entirely preventable with modest effort. Beyond the legal and financial structures, I encourage you to communicate with your heirs about your wealth and your values. Tell them what you hope the money will do. Share the principles that guided your accumulation. Help them understand the responsibility that comes with inheritance. Money without guidance often does more harm than good. Heirs who receive windfalls without preparation frequently squander them. The preparation is as important as the money itself. I have seen wealthy families destroyed by inheritance. Children who never learned to work because they expected a big payout. siblings who stopped speaking because of disputes over assets, grandchildren who developed entitlement attitudes that ruined their own careers and relationships. Money can be a blessing or a curse depending on how it is handled. Your job as the older generation is to set things up so that money is a blessing. This starts with communication. Do not keep your finances a secret from your family. They will find out eventually. And surprises often cause problems. Talk to your spouse about where everything is and how it works. Talk to your adult children about your intentions. Make sure everyone understands what to expect. I recommend involving your heirs in financial discussions while you are still able. Not to give them control or access, but to educate them. Explain your investment philosophy. Show them how you think about spending and saving. Share the mistakes you made and what you learned from them. This education is part of your legacy. The values and principles you pass on may be more valuable than the money itself. An heir who inherits $500,000 and blows it in 5 years has received nothing of lasting value. An heir who inherits $200,000 but also inherits wisdom about money may be set up for life. I also strongly recommend having the difficult conversations about end-of-life care. What are your wishes if you become incapacitated? Who has power of attorney? What kind of medical care do you want or not want? These conversations are uncomfortable, but they prevent enormous stress and conflict later. When my sister passed away, we had already discussed everything. There were no surprises, no disputes, no uncertainty. The family could focus on grieving and supporting each other instead of fighting about decisions. That was a gift she gave us by being willing to have hard conversations while she was healthy. Think about what you want to leave behind. Not just the money, but the values, the stories, the lessons, the love. Those are the parts of your legacy that really matter. Now let me share some specific tactical recommendations that flow from these principles. First, reassess your stock allocation as you age. The old rule of thumb was to subtract your age from 100 to determine your stock percentage. At 70, you would have 30% in stocks. I think this is too conservative for many people, but the direction is right. Your stock allocation should decrease as you age and as your time horizon shortens. What is the right percentage? It depends on your specific situation. How much do you have? How much do you need to spend? Do you have pension income or Social Security that covers your basic needs? How would you react emotionally to a significant portfolio decline for someone with ample assets, good health, and the ability to tolerate volatility? Staying at 50 or 60% stocks might be appropriate even at 70 or beyond. For someone with limited assets, poor health, or low risk tolerance, 20 or 30% stocks might be more appropriate. The key is matching your allocation to your needs and your temperament. Do not follow a formula blindly. Think about your specific situation and make a deliberate choice. Second, hold enough cash or short-term bonds to cover several years of expenses. This is your buffer against sequence of returns risk. If the market crashes, you draw from this buffer instead of selling stocks at depressed prices. By the time you exhaust the buffer, stocks have hopefully recovered. I recommend holding at least 3 to 5 years of living expenses in stable assets. If you spend $50,000 per year beyond Social Security and pensions, hold $150,000 to $250,000 in Treasury bills, money market funds, or short-term bonds. Yes, there's a large allocation to low-returning assets. Yes, it will drag on your overall returns in good times, but it provides insurance against the worst outcome, running out of money because you were forced to sell stocks during a crash. That insurance is worth the cost. Third, focus on quality over yield when selecting income investments. It is tempting to chase the highest yielding stocks and bonds. A stock yielding 8% seems more attractive than one yielding 3%. A bond yielding 7% seems better than one yielding 4%. But high yields often signal high risk. The company might be in financial distress. The dividend might be unsustainable. The bond might default. Chasing yield leads many retirees into investments that blow up, causing permanent capital loss. I focus on companies with moderate yields that are well covered and growing. A 3% yield that grows at 7% annually becomes a 6% yield on your original investment within 10 years. That beats a risky 8% yield that gets cut in half-fourth. Be very careful with annuities and other complex financial products. The financial industry loves to sell annuities to retirees. They sound appealing. Guaranteed income for life, protection against market volatility, peace of mind. But the details matter enormously. Many annuities have high fees that eat into returns. Many have surrender charges that trap you for years. Many have complex provisions that benefit the insurance company more than the policyholder. I am not saying all annuities are bad. Some, like simple immediate annuities from high-quality insurers, can make sense for certain people. But approach any annuity purchase with extreme caution. Read the fine print, understand the fees, make sure you know exactly what you are buying. If a financial product is so complex that you cannot explain it simply, you probably should not buy it. Complexity in financial products usually benefits the seller, not the buyer. Fifth, do not ignore inflation. Many retirees assume their expenses will stay constant in retirement. They calculate how much they need based on today's prices and assume that number will remain valid for 30 years. This is a dangerous assumption. Inflation erodes purchasing power relentlessly. At 3% annual inflation, prices double every 24 years. At 4%, they double every 18 years. The $50,000 that covers your expenses today might need to be $75,000 in 15 years. Your portfolio needs to grow at least enough to keep pace with inflation, or you will find yourself slowly getting poorer in real terms. This is another reason to maintain some equity exposure even in retirement stocks. Over long periods have historically outpaced inflation. Bonds often have not 6. Consider your spending flexibility. Not all retirement spending is fixed. Some expenses like housing and health care are relatively inflexible. Others like travel and entertainment can be adjusted based on portfolio performance. If you have significant flexible spending, you have more ability to weather market downturns. You can cut back discretionary spending during bad years and increase it during good years. This flexibility reduces the risk of running out of money because you can adjust your draw rate to match your portfolio performance. Build this flexibility into your retirement plan. Know which expenses you can cut if needed. Have a plan for what you would do if the market dropped 30% in your first year of retirement. Hope for the best, but prepare for the worst. Seventh, stay engaged but not obsessed. This is a balance I have worked hard to find in my own life. On one hand, you should not completely ignore your finances. Fraud happens, mistakes happen. You need to review statements periodically and make sure everything is as expected. On the other hand, you should not spend your retirement obsessing over your portfolio, checking prices daily, watching financial news constantly, stressing about every market fluctuation. This is no way to live, and it does not improve your outcomes. Find a middle ground. Maybe you review your portfolio monthly or quarterly. Maybe you have an annual meeting with an advisor to assess whether you are on track. But between those checkpoints, live your life. Focus on family, health, interests, and contributions. The portfolio will take care of itself if you have set it up properly. Let me close with some reflections on what I have learned about money and life as I have gotten older. When I was young, I thought about money constantly. I was fascinated by compounding. I loved the game of investing. Building wealth was one of my greatest pleasures. As I have aged, my relationship with money has changed. I still enjoy investing. I still come to the office every day to manage Berkshire, but money itself has become less important to me. What matters more is the relationships, the impact, the meaning. I have come to believe that the purpose of wealth in the later stages of life is freedom and contribution. Freedom to spend your time as you choose with the people you love, doing things that matter to you. And contribution, using your resources to make the world better in whatever way is meaningful to you. A well-structured portfolio supports both of these purposes. It provides the income you need to live comfortably and independently, and it provides the capital you can deploy, either now or after you are gone, to causes and people you care about. And you are over 70 and you have accumulated any meaningful wealth, you have already won the game. You do not need to keep score anymore. You do not need to compare your returns to some benchmark. You do not need to chase the latest investment fad. What you need is a strategy that protects what you have built, generates the income you require, allows you to sleep at night, and enables you to focus on what truly matters in whatever time you have remaining. That is what my final portfolio strategy is designed to do. Capital preservation, simplicity, income generation, strategic inactivity, legacy planning. These principles have guided my approach as I have gotten older, and I believe they can guide yours as well. The greatest investment you can make at this stage of life is not in stocks or bonds. It is in the people and causes that matter to you. The portfolio exists to support that investment. Never let it become the end rather than the means. I have been extraordinarily fortunate in my life, fortunate in my health, fortunate in my family, fortunate in the opportunities I have had. And yes, fortunate in the wealth I have accumulated, but I am most grateful for the wisdom that age has brought, the clarity about what matters and what does not. I hope that sharing my final portfolio strategy provides some useful guidance for your own journey. But more than that, I hope it reminds you that the money is not the point. The money is just a tool. Use it wisely, protect it prudently, and then get on with the business of living a meaningful life. That is the best investment advice I can give to anyone over 70. It has taken me 94 years to fully understand it. I hope it takes you less.